Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today, on September 28, 2025, we are taking a deep dive into one of the most watched currency pairs in the world, the EURUSD. There has been some major volatility recently, and the news cycle is packed with conflicting signals, so we're going to untangle it all, starting with the fundamental drivers and then moving to the charts. First, let's talk about what's moving the market right now. The big story has been the resurgence of the US dollar, which has been gaining strength across the board. This is largely due to a series of robust US economic data points, including an upward revision to Q2 GDP growth and stronger than expected durable goods orders. Weekly jobless claims have also dropped, painting a picture of a resilient US economy. This has supported the dollar despite the Federal Reserve's recent rate cuts, as Chairman Powell's commentary suggests a cautious, risk management approach rather than an aggressive easing cycle. On the other side of the pair, the euro is facing headwinds. We're seeing signs of disinflation in the eurozone, highlighted by a significant drop in Germany's producer price index. The European Central Bank, or ECB, has maintained a dovish stance, with key members acknowledging that inflation has slipped below their target, which opens the door for potential monetary easing. This divergence in central bank policy, with a relatively hawkish Fed and a dovish ECB, is fundamentally bearish for the EURUSD. However, there is a counter-narrative brewing. Some analysts are pointing to recent U.S. personal consumption expenditures, or PCE data, which could suggest inflation is cooling enough for the Fed to consider more rate cuts. This has caused some renewed downside bias in the dollar and fueled a minor rebound in the euro from its recent lows. So we have a classic tug-of-war, strong underlying U.S. economic performance versus signs of cooling inflation and a weak eurozone economy. Long-term forecasts from major analysts like those at FX Street are even calling for a potential return to parity, or 1.0000, citing a macroeconomic landscape that favors the dollar. Now, let's bring up the daily chart and see how this narrative has played out in the price action. Looking at the full picture over the past several months, we can see a clear uptrend that began earlier in the year. Price climbed steadily, breaking through several resistance levels. However, that momentum completely shifted right here in mid-September. As you can see, the pair put in a significant yearly high right around 1.1918. This peak marked a major reversal point for the pair. Since that high, the trend has been decisively downward. Let's zoom in on the price action since that peak to get a better look at this downtrend. This is where the news of a strengthening U.S. economy really started to take hold in the market. We see a series of aggressive red candles indicating strong selling pressure. The market has been making consistent lower highs and lower lows, which is the textbook definition of a downtrend. Price fell from that 1.1918 high, and just a few days ago, on September 25th, it established a critical low right around 1.1645. This level is now the key short-term support that everyone is watching. The last daily candle on September 26th shows a slight bounce, closing just below the 1.1700 mark. This corresponds with the news we mentioned about a potential short-term rebound, but the overarching structure remains very bearish. Now let's switch over to the 1-hour chart to analyze the recent price action in more detail. Here we can see that sharp sell-off from above 1.1740 down to that key support at 1.1645. After hitting that low, the price has been attempting to form a base. We are currently consolidating in a range, roughly between that 1.1645 support and minor resistance around 1.1700. A sustained break above 1.1700 would be the first bullish sign for short-term traders, potentially opening the door for a move towards the 1.1740 to 1.1750 zone, which acted as support before it was broken. This area will now likely act as significant resistance. Conversely, if sellers regain control and push the price back down, a break of the 1.1645 low is the trigger for the next leg down. The market is essentially coiling here, waiting for its next catalyst, which could very well be the upcoming US PCE data release. If we look even closer on the 15-minute chart, we can see the choppy, range-bound action of the last couple of sessions. The price has been oscillating around the 1.1680 to 1.1700 levels. This short-term time frame highlights the indecision in the market. For day traders, the boundaries of this consolidation are the key levels to watch. A breakout above the range high could signal a quick move to test the 1.1740 area. A breakdown below the range low would likely lead to a swift retest of the major support at 1.1645. Volume has been relatively average during this consolidation, suggesting neither buyers nor sellers have taken firm control just yet. So let's synthesize all this information into clear bullish and bearish scenarios. The bearish case is currently stronger and is supported by the dominant daily trend and the fundamental picture. The primary driver is the policy divergence between a resilient U.S. economy and a struggling Eurozone. If EURUSD breaks and closes below the critical support at 1.1645, it would confirm the continuation of the downtrend. The next logical targets for bears would be the support levels identified by Fibonacci retracements, around 1.1580 and potentially even 1.1500 in the medium term. Any rallies towards the 1.1750 resistance area are likely to be seen as selling opportunities by bearish traders unless the fundamental narrative changes. Now for the bullish case, which is more of a short-term, counter-trend scenario at this point. For bulls to gain any control, they must defend the 1.1645 support level at all costs. A successful defense, followed by a break above the 1.1700 and then the more significant 1.1750 resistance, could spark a short squeeze. This would target the next resistance level near 1.1820. This scenario would likely require a catalyst, such as significantly weaker than expected U.S. inflation data, which would increase the odds of more aggressive Fed rate cuts. Without that catalyst, any upward momentum will struggle against the strong overhead resistance and bearish sentiment. To recap, let's go over the most important things to watch for. The key price levels are absolutely critical right now. Immediate support is the recent low at 1.1645. Below that, we're looking at 1.1580 and 1.1500. On the upside, minor resistance is at 1.1700, followed by a much stronger resistance zone from 1.1740 to 1.1770. A break above that puts the 1.1820 level into focus. So, what is my outlook? Given the powerful daily downtrend and the supporting fundamentals, the path of least resistance appears to be lower. I would place about a 65% probability on a scenario where the 1.1645 support is eventually broken, leading to a continuation towards the 1.15s. This view would be reinforced if upcoming U.S. data continues to show economic strength. The alternative scenario, a bullish rebound, has about a 35% probability at this stage. Its likelihood would increase significantly if we see a firm hold above 1.1645 and a decisive break of 1.1750, especially if fueled by weak U.S. PCE data. Keep a close eye on the economic calendar and these key chart levels to guide your trading decisions. That's our analysis for today. Thank you for tuning in to Explain the Charts. If you found this video helpful, please hit the like button, subscribe, and ring the bell so you don't miss our future updates. Trade safe, and we'll see you next time.